$200 billion. I've been staring at this earnings report all morning. My coffee's gone cold, and I'm still just looking at that one number.
It's hard to look away from it.
200 billion. It feels less like revenue and more like, I don't know, the GDP of a nation. But here it is, plain as day. The release from January 28, 2026. Meta officially crossed it.
They did. For the full year of 2025, to be precise, it's $200.97 billion.
Yeah.
I mean, that puts them in a very, very exclusive club.
Yeah.
There are just not that many companies in history that have ever operated at this kind of financial altitude. You're talking oil giants, maybe Walmart, a couple of other tech behemoths, and that's about it.
And that is exactly why we're doing this deep dive. We're not just here to, read a balance sheet out loud. We want to unpack what feels like our real pivot point in tech history.
Absolutely.
Because the story this Q4 and full year report tells is, well, it's contradictory. It's almost schizophrenic, really.
It creates a lot of tension, that's for sure.
A ton. You have a company that is just printing cash faster than ever, but it's also getting ready to spend it on a scale that I don't think I've ever seen before. It's like they're building this fortress and then immediately trying to launch a rocket out of the courtyard with the bricks.
That's a great way to put it. It really holds up. You've got the family of apps, Facebook, Instagram, WhatsApp, just chugging along as this incredibly efficient, financial engine.
A cash cow.
Exactly. And then grafted onto that, you have this historic, almost aggressive ramp up in spending for 2026 to build what Mark Zuckerberg is now calling personal superintelligence.
Personal superintelligence. Yeah, we are definitely going to circle back to that phrase because it sounds like science fiction, but the price tag is very, very real. But okay, before we get to the future, let's ground ourselves. The numbers. Q4 2025, what's the headline?
The headline is, it's really acceleration. Looking at just the fourth quarter, revenue hit $59.89 billion. That is up 24% year over year.
Okay, let's just pause on that. 24% growth. I mean, the law of large numbers is supposed to kick in at some point, right?
You think so?
When you're this big, you're supposed to slow down. You don't see an elephant suddenly sprinting like a cheetah.
It really does defy the normal life cycle of a mature tech company. And for the full year, revenue was up 22%. So it wasn't just a Q4 fluke. It was consistent. But if you were just scanning the report and you jumped straight to net income, the actual profit, you might have done a double take.
I did. I definitely did. I saw the revenue soaring, but then, full year net income is actually down 3% to $60.46 billion. So sales are way up, but profit is down. Doesn't that ring an alarm bell?
It would normally.
Yeah.
But this is the aha moment for anyone who reads the footnotes. It's not an operational failure. This drop is almost entirely due to a very specific one-time tax event.
Okay, walk me through this. Because tax event usually sounds boring, but when it erases billions in profit, I'm interested.
The report specifically cites the implementation of the One Big Beautiful Bill Act.
Wait, stop. You're kidding me. That is the actual name, the One Big Beautiful Bill Act.
I could not make this up. That is the name.
Yeah.
And back in Q3 of 2025, this act triggered a one-time non-cash tax charge of $15.93 billion.
$16 billion. Just gone.
On paper, yeah. But the key phrase there is non-cash. This is an accounting adjustment. It's about deferred tax assets shifting around.
Hey.
It's not like a suitcase with $16 billion left in Menlo Park.
Okay.
If you strip that charge out, the business is incredibly healthy. Their effective tax rate for the year would have been about 13%. Because of the charge, it was reported 30%.
So the engine's running fine. They just had to swallow this bitter pill from the accountants. But speaking of expenses, there was another number that made me raise an eyebrow. Total costs and expenses for Q4 surged by 40%. We just said revenue is up 24%, but costs are up 40%. That feels like a dangerous trend. Spending is growing almost twice as fast as income.
In a vacuum, yes, that would be a huge red alert. But it's all about context. That 40% jump, which is to about $35 billion, is largely driven by two things: infrastructure and technical talent.
The AI push.
They were hiring engineers and buying hardware at a breakneck pace. This isn't bloat, it's preparation. They are deliberately ramping up the burn rate.
Okay, but to spend that kind of money, you need a very, very reliable income stream. And for Meta, that is still all about the users and the ads.
And the scale of that user base is, well, it's just hard to wrap your head around. The Family Daily Active People, or DAP, for December 2025, that hit 3.58 billion.
3.58 billion people. That's nearly half the population of the planet checking Facebook, Instagram, or WhatsApp every single day.
And here's the kicker. Even at that insane level of saturation, they still grew 7% year over year.
They're running out of humans with internet access.
You would think so, but they keep finding more.
And they're getting better at monetizing them. I was looking at the ad metrics, and it seems like they hit this, like, holy grail of advertising economics.
They really did.
Mm.
Usually in the ad world, it's a trade-off, right?
Yeah.
You show more ads, the price per ad drops, supply and demand.
Sure.
But in Q4, ad impressions went up by 18%, and the average price per ad also went up by 6%.
So demand from advertisers is just off the charts. They're seeing more ads, but they're also fighting harder to buy them. Is that just a good economy, or is the product getting better?
Oh, it's almost certainly the AI investments paying off in the background. AI for Meta is a prediction engine. It predicts exactly which ad you are most likely to click on. That 6% price jump tells me the targeting is getting scarily good.
The algorithm is getting smarter. I did notice something interesting in the geography of all this, though. The money is still very Western-centric.
It is. It's the classic meta dynamic. If you look at the revenue charts, the US and Canada block is massive, just huge. But now look at the growth in impressions.
Right, I see it here. Ad impressions in Asia-Pacific are up 23%. Rest of world up 24%. But US and Canada only grew 5%.
So the user growth is happening all over the globe, but the money, the actual monetization, is still heavily reliant on the US, Canada, and Europe.
So the strategy is get the rest of the world hooked and then just wait for their economies to catch up.
Precisely. It's a strategy that's worked for 2 decades. But this brings us to the real internal conflict of the company, the tale of 2 segments.
The cash cow versus the furnace.
Yeah, that's a good way to put it. You have the family of apps segment. In Q4 alone, it brought in $58.9 billion in revenue, and the profitability is just absurd. The operating income was $30.8 billion.
$10 billion a month in profit. Just from the apps, that's the bank account.
That's the bank account.
Right.
And then you have Reality Labs. This is the VR, AR, Metaverse division.
The financial black hole.
The numbers are pretty stark. Q4 revenue for Reality Labs was $955 million. That's actually down from over $1 billion the previous year.
So sales of headsets are dipping.
They are. But the losses, they're not dipping. The operating loss widened to $6.02 billion in 1 quarter.
Wow.
And for the full year, Reality Labs lost over $19 billion.
$19 billion lost in a year. I mean, most companies would kill to have $19 billion in revenue, let alone lose it on a side project.
And this is the strategic question, right?
Yeah.
Why? Why keep burning $19 billion a year on a segment with shrinking revenue?
Is it just stubbornness?
I think it's conviction. Despite this big pivot to AI, they have not given up on the hardware dream. The outlook says Reality Labs' losses in 2026 will stay at similar levels. They're not cutting bait. They believe that to win AI, you eventually have to own the device on your face.
So another $20 billion down the drain next year on headsets. But here's the thing. That $20 billion is actually a drop in the bucket compared to the 2026 AI plan. We have to talk about the outlook. This is where the numbers get truly shocking.
This is the absolute core of the entire report. Mark Zuckerberg's statement was short, but it was heavy. He said, "I'm looking forward to advancing personal superintelligence for people around the world in 2026.
Personal superintelligence. He didn't say better AI or smarter feeds. He said superintelligence. That's a very specific and very loaded term.
It signals a move towards AGI, artificial general intelligence, and building that is expensive. If you scroll down to the capital expenditures, the CapEx guidance, this is the number that just floors me.
Okay, I have it right here. So for context, in 2025, their CapEx, so buying servers, building data centers, was $72.2 billion, which is already a huge number.
A massive number. Now, read the guidance for 2026.
We anticipate 2026 capital expenditures to be in the range of $115 billion to $135 billion.
$135 billion.
That's nearly double in a single year.
To put that in perspective for you, $135 billion is more than the entire GDP of countries like Morocco or Slovakia.
Yeah.
They are spending the economic output of a nation on servers in 1 year.
And it explicitly says this is to support their Meta Superintelligence Labs efforts. They are going all in. What does that even buy you?
Right.
A warehouse full of NVIDIA chips.
It's the whole stack. Yes, it's hundreds of thousands of GPUs, but you can't just put those in a closet. You need massive, massive data centers.
Yeah.
And crucially, you need energy.
Energy.
You can't just plug these things into the wall. These training clusters require gigawatts of power. So that $135 billion is also an infrastructure bill for a new digital utility. They're building the power plants, effectively.
It is the single biggest bet in the history of tech, period.
It has to be. And it's not just buying the hardware. The total expense guidance for 2026 is between $162 and $169 billion, because you have to depreciate the hardware and you have to hire the people to program it.
The AI researchers who command NBA player salaries.
Right. But here's the risk, and this is the big one. If you spend $135 billion on hardware, you have to have a product that makes at least $135 billion, right?
That is a multi-billion-dollar question, isn't it?
The ad business gives them a buffer. They can afford to be wrong for a little while. But if they spend this money and it doesn't fundamentally change how we use the internet, this becomes the most expensive science project in history.
It's a high wire act. They're using the profits from you scrolling Instagram to basically build a machine god.
In a way, yes. They're betting the future isn't about social feeds. It's about having an AI agent in your ear or in your glasses, helping you navigate the world. And they want to own the brain behind that agent.
And of course, they aren't doing this in a vacuum. There are headwinds.
Always. The regulatory landscape is getting trickier.
I saw the CFO mention something about the European Commission.
Yes, in Q1 2026, they're rolling out a less personalized ads offering in the EU.
Less personalized ads. That sounds like kryptonite to their whole business model.
Yeah.
We just said the reason the prices went up is because the ads are hyper-personalized.
Exactly. That's the tension. The EU is forcing them to offer a version of the product that's inherently less valuable to advertisers. It's a direct threat to that ad engine.
And it's not just Europe. The report mentions scrutiny on youth-related issues and trials in the U.S.
And the language is specific. It says these trials could result in a material loss. In corporate speak, that means this is going to cost us a lot of money.
So legal battles in the U.S., privacy clamps in the EU, and all while they're trying to build the most advanced AI on the planet.
It's a lot. But when you zoom out, the fortress is still incredibly strong. They generated $14 billion in free cash flow in just the fourth quarter.
$14 billion in cash, free and clear. That gives you a lot of room to play with.
It does. It lets them absorb these shocks. But the sheer scale of the 2026 investment changes the calculus. They're trying to force an evolution of the internet.
Okay, so let's bring this all together. What this deep dive tells us is that Meta is a money printing machine. It's powered by 3.5 billion people scrolling their phones.
Right.
And they're taking all those winnings and dumping them into two giant furnaces. The metaverse, which is still burning cash, and now this superintelligence project, which is about to consume more capital than we've ever seen.
That's a perfect summary.
Yeah.
They are betting that social connection is about to be completely redefined by AI. You won't just connect with friends, you'll connect with and through an AI agent.
And for you, the listener, why does this all matter? Because the tools you use every day are about to change radically. If Meta is spending this much, that technology is going to get pushed into your Instagram feed and your WhatsApp chats, whether you want it or not.
We're moving from a passive era of just looking at a feed to an active era of assistance. The computer won't just show you things. It will do things for you. That is the promise of that $135 billion.
It's a bold new world. So I want to leave you with this thought. Meta plans to spend up to $135 billion on infrastructure next year. That is an astronomical amount of resources. If personal superintelligence is the product, what does that actually look like for us? And maybe more importantly, is there any version of an AI assistant that is valuable enough to pay back a $135 billion annual bill? Or are we just watching Icarus fly toward the sun on a rocket ship made of GPUs?
It is the ultimate gamble. But if history's any guide, betting against this company's ability to pivot has usually been a losing strategy.
We shall see. 2026 is going to be a fascinating and very expensive year. Thanks for diving in with us.
Always a pleasure.